Hello, welcome Self-Made Nation to the Cash Rich Exit podcast. I'm Colleen O'Connell-Campbell, wealth advisor at RBC Dominion Securities, and your host. Listen, you're a founder, CEO, business owner, and this is your roadmap to exiting, cash rich exiting. In today's episode, we're going to be unpacking tax smart retirement strategies for you, the incorporated entrepreneur business owner. I'm joined by Muneer Feeroze and Clark Steffy, both of Canadian Benefits Associates. Muneer is managing partner and founder of the firm. Clark is director of actuarial and consulting services. Together, we're going to break down some of the misunderstanding of this massively powerful tools actually, IPPs, individual pension plans, and RCAs, retirement compensation arrangements. Yes, an alphabet soup of terminology. It's not just for financial nerds. These tools, you can use them to lower tax burdens, boost retirement income, and build lasting wealth. So stick around as we dive into this interesting strategy. Well, welcome Muneer and Clark here to have the ABCs of IPPs and RCAs. Before we dive into maybe some of the technical background, how about sharing with those who are listening and watching here just a little bit about yourself so they know who you are as we get into this topic. Muneer, how about you first?
Well, thank you. Thank you for having us, Colleen. A little bit background about myself. I've been in the industry for about 30 to 35 years. Started off at the larger actuarial consulting firms, then moved to smaller boutique firms. And for the last 15 or so years, have been working at CBA, which I'm a founder of, providing tax solutions from an actuarial IPP RCAs for small businesses.
There you go. And Clark.
Yeah, so I've been in the pension industry for 30 plus years and met Muneer maybe 20 years ago. And we've been working together ever since. I formally joined his firm only about 2 years ago, but I've been referring financial advisors who I've served my entire career and their clients. For all that time, I've been referring them to Muneer because he does such a good job, and I've got to work with some of his other actuaries, some of which I've known even longer than Muneer. So it's a great team, and it's a lot of fun.
That's awesome. Well, I think that the way that we met was, Clark, I think you reached out to me because I had written an article that appeared in the National Post all about our RSPs and IPPs for the incorporated business owner. And so since then, we've been talking and you've gratefully provided your expertise to some small group sessions, and I hope we'll be able to continue those. And why not bring you on the podcast and share with the broader audience, right?
Yeah, thank you, Colleen. It's been a lot of fun and a
Yeah.
pure luck that I found you probably. I saw your article and called you.
Yeah. So here we are. I think best to start with the basics. And as far as tools are concerned, um, within the landscape of what's available, we've got tax-free savings accounts and we've got registered retirement savings plans and these things called IPPs or individual pension plans. And they've been around for a while, but somewhat misunderstood and some legislation changes. So I'm going to leave it with you two to say where would be the best place for us to start to share how this all works, where it
I
might
think
fit.
I think that's a really good recap, Colleen. IPPs slash RCAs are not new financial products. They've been around for quite a while. The first IPP was set up back in 1985. What has happened over the years, yes, they have been misunderstood as a financial product, but more recently, over the last, I would say, a decade, they have started to become more and more prevalent, and more small businesses are setting them up. So in general, when you do have a small business, some of the tax advantages over the last 10 years have been reduced. So the ability for business owners to keep funds inside of a corporation and get tax advantages has been reduced. So one of the financial products that accounts are now using is an individual pension plan. What an individual pension plan does at a higher level is if you were to look at an RSP, we basically are able to put in 18% up to a certain dollar cap, about $32,000 and change in an annual basis. What an IPP does is it allows the business owner to put in significantly more depending on their age. So if a business owner that's closer to, say, age 65 would be able to put in as much as 29% of the contributions into an IPP and get a full tax deduction. Then we have a financial product called the RCA, and I'll just tie the two of them together. What the RCA does is much similar to an RSP where in the current year, if you are making more than $180,500, it caps your contribution to the RSP. Similarly, in an IPP, after a certain dollar value, it caps the amount of dollars you can put in. There's a Revenue Canada or Income Tax Act limit. The RCA allows you to fund or get tax deductions or fund a retirement benefit in excess of that dollar cap, which for IPPs this year is 187,000.
Yeah. And so just to preface, we are recording in the latter part of 2024,
Right.
25. Oh my goodness, I'm rewinding the clock. And we suspect that you'll be hearing this and you'll be seeing this in the early part of 2026, probably January. So are those amounts you're talking about, that would be so that sort of first 60 days of 2026, right? Contribution for the 2025 tax year.
Right. So the IPP limits will get published, say, mid to end of November for 2026, right? So the $187, $334 limit for this year will increase. We just don't know what it is, but it will increase. But for the RSPs, it will be about 108. It will be 187,834 because it lags 1 year behind the IPP limits.
Okay, there you go. And also to preface, we're focusing mostly on Ontario here because I'm situated in Ottawa. You're whereabouts again?
We are in the Greater Toronto area.
Greater Toronto area. So all that other area.
Yeah.
Yeah, great. And typically, at what stage of business and what stage of life, the combination of those two is a good time to start considering an individual pension plan if you're the business owner?
I think that's a great question. There's two aspects of it, I would say. One is the preparatory phase, and one is actually setting it up. The IPP, unlike an RSP where the contribution is 18% no matter what your age is, in an IPP, the contribution rate increases. As you get older, the contribution rate increases. So the crossover age is age 39. So under the age of 39, if you were to set up an IPP, you would generally get a contribution rate less than 18%. So in a lot of cases, we'll say to clients, ensure that you're getting the T4 income, but just maximize your RSP contributions. When you hit 39 or age 40, at that point in time, then you could set up an IPP. So the contribution rate, because it's age dependent, at around age 39, it's about 18%. At age 65, it's about 29%. So that's the key. Now, when we say preparatory, one thing for business owners to be very cognizant of is when we're creating our contribution room or we're contributing into an IPP, it's based on T4 income and not dividend income. So that's really important. It's very similar to an RSP. You can't contribute into an RSP based on dividend income. It's only on your employment or T4 income. So in the preparatory phase, the pre-age 39 phase, if it's possible and if it makes sense, one of the things that we do suggest, and check with your accountant, your tax advisor, if it's If it doesn't make any difference whether you're taking dividend or T4 income out of the corp, try to maximize the T4 because when you do set it up, there is a concept in the IPP world where you can go and create past service. In other words, if you've been receiving high T4 income since when you were 30, 32, 33, we can go back to that age and create some additional tax deductible contribution that business owners can take advantage of.
And those contributions are, okay, so in the RSP function, the deduction is a personal deduction, right? Um, from the IPP perspective, it's a little bit different.
That's correct. So if you're looking at the cash flow in an RSP basis, so let's use an example of $100,000 and you wanted to put in $15,000 into the RSP. So in general, what would happen is your company would pay you the $15,000 extra. Your T4 income would be 115. You personally would contribute to your RSP and you'd get a $15,000 tax receipt. And then your net income would be 100,000. In an IPP, if you were to make that same $15,000, your corporation would not make that income or would not pay you that extra amount for you to put it into the IPP. It's a direct contribution from your corporation into the IPP. And that's where the subtle difference is. For an IPP, you do need a corporation to set it up. So it's not an individual sponsorship, it's a corporate sponsorship, and it's corporate contributions going directly into an IPP.
And Clark, in your years of working with wealth advisors, investment advisors, when have you seen that advisors are talking to business owners about this? Or when do you think is the best time for us in this chair, as this resource to business owners? When should we be starting to have these conversations with our business owner clients?
Yeah, well, there's this sort of age 40 cutoff where the IPP looks more attractive than the RSP in terms of contribution room. So there's that. But there's also a concept of when you're in the mode of starting to take money out of your business. And there's so many reasons why it's harder today to get money out of your business because the TOSI or tax on split income rules, you can't just dividend sprinkle across. And then there's these passive income rules that penalize you for holding assets in your corporation. And then there's also these also passive income rules that if you don't get that money out of your business, you can actually lose your lifetime capital gains exemption. So these are discussions, and then there's the intergenerational wealth transfer if you've got your kids coming into the business. So it's in that sense, it's almost never too early to start to bring these topics up so that you can do long-term planning. If you might be hearing about it for the first time when you're 35, everybody could decide, yeah, this is something I definitely need to be doing when I'm a little bit older and a little bit getting money out of the corporation mode, but it's good to know about it and start to plan for it. Because I think we see a lot of situations where business owners never thought they were going to sell their business and then they get an offer they can't refuse. Or all of a sudden their kids had no interest in joining the business, and all of a sudden they say, well, I wouldn't mind joining the family business. So it's almost in that sense, it's never too early to start to at least educate business owners about the concept and for down the road, even if today's not the time.
Who who are the right team members to bring into play if I'm the business owner? Who should I be talking to outside of my wealth advisor if I want to investigate an IPP and potentially an RCA?
This is kind of my favorite topic, so I'll take this one in here and you can chime in. I really like the team effort approach. So often the financial advisor is the quarterback because they have the best relationship with the business owner. They manage their assets, maybe handle life insurance type products, investment type products. It could be a wider range of services, almost act like a counselor to the client. Whereas the accountant is critical in these meetings as well, or can be at some stage during the process because they understand the client's tax situation. And now, accountants I find are a little bit more transactional and maybe know the client less well than the financial advisor, but they're still critical. And then we as actuaries, just because we work on the IPPs and RCAs all day, every day, we have certain knowledge that the other parties don't have. It's rare. It's interesting. It's rare that clients actually have very much knowledge on
That's
these
true.
topics, unless the client's an accountant or a financial advisor themselves.
Well,
But they,
and we've had some sessions with accountants on board where we wanted to share this knowledge with this group of professionals because there's a lot of myths out there about things like the cost of IPPs and the how rigid they are. And there's been a lot of changes that have taken place, I guess, in particular in the last like 5 years or so in Ontario in particular, about how much like the obligation to fund the IPP. So maybe we could talk about a few of those issues that tend to crop up as kind of the barriers to considering an IPP. So let's work under the assumption that we've got someone who's at that threshold, like they're over 40, they're got a T4 income that is at the top level for funding an IPP. Business is cash flow positive. But maybe they are still concerned about what if I do run into a year where there's something unexpected comes up, like you know, heaven forbid, a COVID situation, or what would be another example? Like the need to really invest more in um, physical like retrofit of space or equipment, and so the cash flow might be obstructed for a bit of time. If we think about that kind of scenario, tell us about the function of an IPP and why it still might fit because of the more recent changes in the rules around setting them up in Ontario.
yeah,
So,
this is
yeah,
sort of near and dear to my heart. So let me just click on
sure.
it, and then you go, Muneer. So when I was been in the IPP RCA business for so long, and in Ontario we had pension regulation that required contributions and required that the money be locked in. With the removal of pension regulation in Ontario for connected business owners, meaning they own 10% or more of the company or their family, direct family members are classed as connected, they removed pension regulation. So CRA doesn't care if you get a tax deduction or not. They don't care if you make your contributions. So as of December 8th, 2020, all of a sudden, all contributions are optional. And a lot of accountants are still, who set these up in the past, still believe that, oh, don't do an IPP, you'll be trapped into making a contribution in years that you maybe can't afford to. So
Yeah, and you
that,
need to redirect those funds somewhere else in the business, right?
right,
Yeah.
right. So all contributions are optional. And so that just was a game changer. But then the tax rule changes came that were even more powerful, and I'll let Muneer talk to those. But that's my view on the removal of pension regulation and why it's how important it is that business owners don't need to put a dollar into this, even if they set them up, and it's just there when they need the tax deduction.
I think I'll come at it slightly at a different angle, which is everything Clark said is true. It's flexible now because of the removal of the pension legislation. But from a business owner's perspective, they're looking at cash flow. One is um, access to cash, and one is new money that they're going to be put in. And absolutely, for new money with the new rules, if you're connected, you do have the ability, just like you do in an RSP. Even though you do earn that 18%, you don't actually have to make that contribution. You can leave it, carry it forward, and then make double the contribution or whatever it is the next year and take advantage of it. And in an IPP, it would work similarly. Where the IPP and RSPs differ is if an individual had, say, $500,000 in an RSP and $500,000 in an IPP, and for, say, COVID hit or some other business issues hit, and they wanted access to that $500,000 that they've already put into an RSP. Now, in an RSP, it's a lot easier to take it out. Yes, you would have to pay tax on that 500,000, but it's available. Whereas in an IPP, it's not as simple. You just can't go to the bank or go to the fund and say, I would like to remove $300,000 out of my IPP. I'll pay the tax on it, and I'd like to access it. So that's one thing that business owners should understand. You do have the ability. You can wind up the IPP and move the money into an RSP and then move the money out. But then if there's a cost associated with it, and that there's a timing associated with it. So when you do wind it up, it doesn't happen overnight. It takes months to have an IPP wound up. Whereas an RSP, you could just walk today and give Colleen a call and have the money transferred to your account the next day
And pay the tax, and
and
then
pay the tax.
and,
That's right.
right. So that part is still remains somewhat rigid
Yes.
from that point of view. There's more flexibility in terms of funding it. There's still an inflexible component when it comes to accessing it, and while you're still operating, unless you wind it down or unless you're over 71 and you're starting to actually pull out
And, and,
your
and,
income from it, paycheck.
and one of the reasons of that is because IPPs are a beneficiary trust, right? So the company puts the money into this trust. So it does also, for small business owners, it does provide creditor protection to a large extent because it's money that the company has now moved from the corporate assets into a beneficiary, into quote a trust fund to provide benefits for the income. So if something happens to the corp, that money is not. Now there are certain rules where they may be able to get access to it, but and we won't get into it today, but in general,
Yeah,
it affords a lot more creditor protection than say just a regular RSPS. It's what.
right. What would you say around the costs? I mean, running an investment portfolio, right? You've got your advisory cost, potentially a management expense fee associated with particular products. Um, and then that's almost it, right? And
Right.
so portfolios over 1 million, for the most part, you're going to see like a 1% advisor fee, and then the MER, management expense ratio, is hopefully well under 1%, maybe 0.5% or even lower, or not at all if it's individual stocks. But let's say that it's definitely under 2% for sure. But what other costs are involved in an IPP? Because costs can also be a stumbling block to wanting to get into it. So ongoing costs, and then setup costs.
I think that's a great point. Unlike an RSP, there are actuarial fees. So the IPP is a specific pension plan customized setup for the company, for the corporation. So there are regulatory filing that have to be done on setup. There is an actual valuation report that basically is filed with Revenue Canada indicating how much money the corporation can put in. And that report needs to be filed once every 3 years. So for all the regulatory filings and everything else, our cost for 2025 is $2,100. It's a little over $2,100 per year plus HST. That includes all the regulatory filings that would normally be required for an IPP to be set up and function. So we do not charge a setup fee, but we do charge a regular annual fee in the first year for the IPP, and our fees are indexed to inflation, so they would increase for 2026.
Right. So you look at it as a flat amount plus an indexing function
Absolutely.
at your firm. And it's
That's
different depending on what actuarial firm you might go to, or
absolutely,
which actuarial service within a larger firm you might deal with. But
absolutely.
so that there's an impact there. That's a due diligence
Yep.
on the part for us as advisors and for clients who are looking to set one up, because not all actuarial firm fees are the same, in other words.
No, they're not. One thing I should say about the fees, if the fees can be paid from the fund, but our fees could also be paid directly by the corporation. The advantage of having it paid by the corporation is our fees are fully tax deductible.
Yeah.
So
And
another
and I'll
benefit.
I'll just also add that we don't charge for the second member, and it's quite common to add the spouse. Let's say the spouse is earning a T4 income from the company. Let's say the business owner adds their spouse because they're paying them a T4 income, and we don't charge for that second member. We sometimes add the kids if they're earning a T4 from the company, then we have a modest fee for each additional member after the second. But it is so common for us to have a second member in the plan that we don't even think about that we don't charge for the second member. Some firms do.
And we're really staying focused here on the business owner. And I did ask you to stay focused there, but it is a product that is available to incorporated professionals, which is basically another type of business incorporation, as well as highly paid executives. But that falls in. There's a whole bunch of other conversation that goes along
Correct.
with that, so we weren't going to dive into that too deeply. Um, what would be, what haven't we covered here that you think would be part of the ABCs of an IPP?
I
Well,
think one is that it's income splittable. So if let's say the business owner is paying them their spouse a T4 income the same amount as them, then it's irrelevant. But if it's not so even, then that really helps. That's a game changer having the income splittable, so that to even out the tax brackets at retirement.
Right.
Sorry, Muneer, I interrupted
no,
you.
no, that's fine. I was just gonna to answer Colleen's question, beyond the tax advantages, a lot of business owners set up IPPs to achieve various different reasons. So some of the other business owner solutions with regards to an individual business owner setting it up could be business purification. I think Clark alluded to that when
He
you're
did.
trying to sell your business. Another could be business transition. You know, you're selling it to the next generation. There's an intergenerational financial planning aspect of it,
Hmm.
i.e., when your kids join. So one example there would be, excuse me, in an IPP, if you have contributed and suppose there's $1 million in the IPP and your children are now participating in the business and receiving a T4, and they join the same pension plan, the IPP, and God forbid something happens to mom and dad, and there's $1 million left in the IPP, but now the kids are in that same IPP. Well, that full $1 million now transfers to the kids' plan. When I say transfer, it just remains in the same IPP. The IPP continues, so there is no tax consequence at that point in time. If it wasn't an RSP, yes, it could go to the kids, but it's fully taxable. So
Right.
that's a huge tax advantage if you do own your own business and you're passing it down to the next generation.
Right. If you're talking about a family succession opportunity.
Exactly.
And then additional, a next gen could further be added to like
Absolutely.
it could continue in as long as the
A
business is
perpetuity.
there in perpetuity, as long as the business is there as the sponsor of the plan and there are connected individuals who within that.
Absolutely.
Yeah, and
Absolutely.
I'm always worried that clients will be confused by this because it's called an individual pension plan. And
Hmm.
here we're talking about putting the business owner, their spouse, their three kids,
Hmm.
five-person plan all of a sudden. So even though it's called an individual pension plan, some people have called it the family pension plan, the FPP, because it is often used in that context. If we had to take a different scenario, let's say we had two brothers who both owned 50% of the business. In that context, we'd probably recommend that they consider separate individual pension plans in case there's a maritable breakdown or something like that happens. They might want their own
Yeah.
individual pension plan. But usually in the family context, there's no downside to put them all in one plan.
Mhm.
And this intergenerational wealth transfer is the reason for doing it. Muneer talked about what happens if this, let's say the mother and father pass away, then the assets can remain in the IPP with no deemed disposition, meaning no tax to the kids. But
Mhm.
we often turn it around and say, well, what if the parents live to 100 and let's say it's a farm business and they're really not working on the farm anymore, but the kids can be funding the parents' pension on a pay-as-you-go basis into retirement. And sometimes that happens because we talk about farm businesses because they're land rich and cash poor. At the time they set up the IPP, they may not have the cash to fund it, but the children may be able to fund it over time and in a way buy the business in that way, in a
Right.
very tax effective way.
Right,
And
right.
when we
In essence,
see,
creating the exit strategy
Yes.
for the the originating generation or the generation that's creating it's something that wasn't necessarily thought of in the past or maybe wasn't fully available. Yeah,
yeah, and
interesting.
we've seen situations where it wasn't just a farm business. Maybe cash was all tied up in inventory, so there was no cash to fund the
Hmm.
pension plan. But again, the children over time could just kind of pay as you go, pay the their parents' pension out of contributions that they're making and getting a tax deduction for the company. So
Yeah.
that once you add that intergenerational element, it becomes quite a collection
Hmm.
of solutions.
Hmm. Well, I think it's easy to visualize the farming succession because typically you think of it as a family transition, whereas other businesses, yes, family, but also, other parties be getting involved more succinctly. Um, any any specific pitfalls to avoid in
With
setting
regards
one,
to, yeah,
setting up? Yeah.
I would say the major pitfall is where people may think of this as more like a cash account, right? Like an RSP that we can pop it in, and if we need it 2 years down the road, we can take it out. There are expenses, so beyond the expense of setting one up and the annual cost, there is a wind-up cost to an IPP because there's a lot of regulatory filings that have to be done, and it ranges from about anywhere from about $3,500 to $5,000 to wind them up. So it's not just so that is the one thing that small business owners may want to consider is the fact that it is there, but normally what we find is for most business owners, they are trying to save for retirement. And in their cases, this diversifies it. It's the money, they get the money out of the corp into an IPP. It's outside, they can't touch it, nobody else can touch it, and it's there for their retirement. It's a retirement nest egg. But if they are looking for complete flexibility, that's when you can run into trouble
Right.
with an IPP because it is not as flexible as, to say, an RSP would be if you're looking to put it in withdrawing it.
But in terms of funding it, setting it all up, there's a lot more flexibility than we thought in the past. And when I talk about cash rich exits, I mean, the reality is that every business owner is going to exit, right? And
That's correct.
so, how do you set yourself up for success and having your cash rich exit? Well, I think we covered a few things. If you find the business was successful but becomes unsuccessful and you're in the unenviable place of needing to go bankrupt, we'll assume that you followed all the rules and it wasn't like a scenario where you set up this IPP because you were trying to avoid a creditor protection. But I'm
Yes.
like, we don't have all the details there, but
Right.
assuming it's been set up and running for quite some time and you haven't tried to do anything foolish, you've
Right.
likely got some creditor protection around
That's
that
correct.
pool of funds.
That's correct.
So even though the business maybe at some point became unsuccessful, you've still created for yourself some kind of an exit from, like some kind of a cash pool here
That's
for
right.
all of your efforts, right? If we
That's
think
right.
about a scenario where it's become an angel. There's a disability. Then again, there can become an angel. We've talked about the ability to see other generations benefit from the pool of funds. Disabled, well, I guess you've got a pool of funds here. If you have to, maybe you can't sell it, maybe you can, but somebody else can come in and run the business and you've still got this pool of funds. So I'm just thinking about you do sell the business. Well, we didn't talk about this, but what happens with the pension if you sell the business?
So that's a good point. So what happens on the sale of business is the IPP needs a corporation to sponsor, right? So most business owners will have an OpCo, operating company, and a HoldCo. The IPP could be set up at either the HoldCo or the OpCo. So if they are looking to sell the OpCo, they can move the IPP or have it sponsored by the HoldCo and the HoldCo sponsor the IPP, and it could continue. So they could sell it, they would retire, and then the monthly or annual income would come out of the IPP until the assets are exhausted out of the IPP. So that's one way to do it. The other way to do it is if they do sell the OpCo, and suppose they don't have the HoldCo, they do have the opportunity at that time to actually wind up the IPP. And when you wind up the IPP, you can move that money back into a non-locked in RSP. And then it just becomes part of the RSP assets. Now, one thing I will point out at that point in time, under the Income Tax Act, there are rules around the maximum transfer from a registered defined benefit pension. And this doesn't hit just an IPP, it's any DB plan.
Any plan.
Right. So if you're taking money out, say out of the Omer's pension plan or the teacher's pension plan, you'd be hit by the same thing. Or, you're working for a large Bell Canada, if they have one, or any large DB plan, it's the same rules that are applicable to them. So basically what those rules say is that if it's over a certain amount, then a portion of that has to be taken out in cash immediately. So I'm just going to use a number. So you had $1 million and you're now winding up the IPP. Maybe seven or 800,000 of it could get transferred. So there's no tax implication. It just means you transfer it with your advisor into an RSP account.
Mhm.
And then the rest of the 200,000 would be paid out to you in cash, and it would be taxable in the year that you took that money out.
So you want to do a little bit of
Tax planning.
timing. Yeah,
Timing and
timing.
time.
Yeah.
Yeah, so what most people do is business owners will do in the year that they do wind up the IPP, they won't take out any T4 or the dividend income from the corporation, and that will become their income for that year.
Yeah. And
That's how
so
they do the tax plan.
the other exit, so we said succession, um, unfortunate bankruptcy, sell to, third
Right.
party. But there's also not bankrupt, but a winding down of a business. So there can be really great cash flow oriented businesses, and this might fall into the category, for example, of a professional incorporated business owner. But there are other businesses that are really highly dependent on the business owner, and if the
Yeah.
business owner is not there, there isn't really much to sell. So I think it's also another way to talk about creating a cash-rich exit that isn't about selling, because again, you have moved these funds over, and to your point, if it's not an opco anymore, and you've got some assets in the holdco, this is still a viable solution. So I really think that it is a product that needs to be examined by a lot more incorporated business owners. So I'm really grateful for you to come on today and share your expertise and continue to run a number of virtual sessions with us here at RBC.
Our pleasure. Thank you, Colleen.
Before I let you go, two
Mhm.
things. Where can the viewer, the listener find you?
We are, the name of our firm is Canadian Benefit Associates. Unfortunately, our website is in revamp, but we will have a website up soon. If you like, we can give you the telephone number or contact, or they can reach out through yourself, Colleen. You have our
Okay.
contact. They
Yep.
can reach out to yourself, and they can reach us through you.
Great. And would you have one piece of fun, frank advice to leave with the self-made nation?
I'll let you go first, Clark.
Well, we always get asked about, and we know we talked mainly about the individual pension plan and didn't talk really about the retirement compensation arrangement, which layers on top of the individual pension plan for T4 income above the maximum allowable for the IPP. But we often get asked, how did Jose Batista get to put $16 million in his retirement compensation arrangement? And it's fun digging into why the RCA retirement compensation arrangement can be so much larger. In the is we've $16 million in those, and there's some interesting thing there. One reason is there's no maximum on T4 income. The other reason is it's similar to the IPP. You can bypass service, but it allows you to use the best 3-year average of T4 income. So you can backfill for, let's say you were paying yourselves dividend all those years, and you can still pick up that past service in an RCA by using the best 3-year average. You can't do that in an IPP. So there's all kind of quirks and flexibilities, and maybe we need a session all on itself to
Right.
talk
I know
about
I called
that.
it ABCs of IPPs and RCAs, but maybe it's the ABCs of IPPs and we have to come back with the one, two, threes of the
Yeah.
RCAs.
I think it's a topic all on its own, but it's an
Yeah.
integrated topic. It's a
Yeah.
related topic, but it's a whole hour in itself. So, but it's a fascinating topic, and
Yeah.
yeah.
Well, we'll aim for that. Muneer.
I think the fun fact that I would probably put out there is in Canada, if you're looking at small businesses, there's probably, and the last stats I checked was maybe about 12 to 14,000 IPPs in existence or set up. And, Revenue Canada's definition of small businesses, in Canada, there's, I believe, between 1.1 to 1.3 million. So it's a financial product that very few people of that business, the small business community are currently taking advantage of. But there are about 12 to 14,000 fellow business owners who are taking advantage of it.
Not enough. I always say to Muneer, we're in the first innings on this stuff, Muneer, because a lot of accountants haven't quite connected the dots on it yet, and there aren't too many Colleens out there that have really sunk their teeth into this. But Muneer tells me, no, Clark, we're not in the first inning. We're in spring training.
Well,
We haven't
I was
got.
gonna say, we're recording this in the thick of baseball. What are the
Jays fever, Blue Jays fever.
Blue
Yeah.
Jays fever? Yeah, and yet we're going to air in January, so therefore, we will be in the thick of hockey season, and
Yeah,
so I
yeah.
think the spring training or preseason training probably is a good
It-
analogy for where we are.
Yeah.
we'll be very quickly into it, right?
Yeah.
February, early February.
Yeah,
Yeah.
exactly. Okay, well, thank you both for being here today, and I look forward to chatting with you again and continuing to spread shine the light on IPPs and their partner RCAs.
Thank you for having us, Colleen.
Thank you,
Well,
Really appreciate
Colleen.
it.
we covered a little bit more of the ABCs of the IPPs rather than RCAs, but they are complementary. Powerful conversation with Muneer and Clark, professionals who understand that it's not just about a retirement structure or the right retirement structure and saving money, but it's about keeping more of what you've earned. Self-Made Nation, if you're serious about building wealth using your corporation as a tool and you haven't yet explored individual pension plans or retirement compensation arrangements, this is your sign to act now. Let's talk. Connect with me, Colleen O'Connell-Campbell, on LinkedIn, or you can email me at colleen.campbell@rbc.com. Book your one-on-one wealth gap analysis. If this episode has shifted your thinking and helped you think about your cash-rich exit a little bit differently, or retirement planning for that matter, through a new lens, then hey, drop us a 5-star rating on wherever you are watching or listening to this particular episode. It helps more CEO founders find the show and build their path towards a cash-rich exit. Thanks for tuning in. I'm Colleen O'Connell-Campbell, Wealth Advisor at RBC Dominion Securities, TTFN. Ta-ta for now.